Good morning, everyone. Anthony Iser is my name, and welcome to another ITPM Flash. I want to talk to you today about a company that I think is going to benefit from geopolitical events. Now, usually geopolitical events don't have a major impact on market on a long-standing basis anyway. It can be short, sharp changes. We often see it with oil prices, with issues in the Middle East. We saw that the same with Russia invading Ukraine and commodity prices. But they tend to revert to the mean as people find alternate sources and alternate methods of production. However, in this case, I think there is an opportunity. So before I get to the actual geopolitical event, I want to talk about the stock. The stock is Zim Integrated Services. It's a shipping company. Now, it's been listed for 3 or 4 years, listed at $15, fell to 11, is now trading at 12 or 13. 13 up a little bit today, I think. That's not the sort of return that an investor would really want. However, during that time, it has risen to more than $80 before coming back to this $13 level, and it's paid out $40 in dividends. So even though the share price would be lower than it was at the IPO, had you bought it then and held on, you've still managed to pick up $40 in dividends, more than 100% return, 200% return. So it's a wild ride, that's for sure. What drives that wild ride is a huge fixed cost base in terms of ships and a very volatile revenue line. So the sales price that they charge can vary dramatically. Recently, it's been down under $2,000. It's been as high as $16,000. What I think is providing the opportunity here is that price is now picking up again strongly. And if it sustains this level for even a small period of time, it's going to generate a huge amount of cash. So, firstly, let's look at the geopolitical event. We've got all sorts of drama in the Middle East. One of the key specific things that's come out of it is attacks on shipping, commercial shipping in the Red Sea and traveling through the Suez Canal. Now, I'm not going to go into the politics of any of this. That's all irrelevant. All we need to know is that ships are not going through the Suez Canal and the Red Sea, and they're finding alternative paths. And as you can see from this chart here, the volume of traffic has fallen off a cliff. And from this chart here, or this map, you can see all those orange ships are going around Africa now. And what that means is higher prices, longer time at sea, and more money for Zim. So those prices are now really picking up, as you can see from the Asia through to Europe price chart here. But Trans-Pacific traffic is much more important for Zim. So you can see from this chart here, that's also picking up from under $2,000 to over $4,000. So what does this all mean? This means that Zim, who has been under a huge amount of pressure because of cash burn at the recent prices well below $2,000, they were not generating profits and generating negative cash flow. And utilization rates are down. So with this, everything is starting to tick up. Now, I think this is what we would consider to be an asymmetrical opportunity here. Now, we can make our opportunities asymmetrical by limiting our risk on the downside through our structure, which is what I'm going to do. But I also think it's an asymmetrical risk here because at the moment, while the share price has moved strongly off the lows, it's not factoring in any of this to any reasonable degree. If the prices stay at these sorts of levels, even just for a few months, the cash generation here is going to be outstanding. If it stays this way through for the next 3 or 4 months, we're going to see a share price here that is substantially higher. As I said, when they've generated cash in the past, they've paid out dividends over a 3-year period totaling $40. In individual years, they've twice paid out dividends that are more than the current share price. They've got a dividend policy, 30 to 50% payout ratio. So that is going to draw people into the market. If there's one specific thing, the geopolitical event continues, that is traffic through the Suez Canal and the Red Sea stops, has to go around, and prices remain high. Okay, so how does this unfold? You can see from this net profit chart and revenue chart, it's very volatile. The last quarter or so has been negative, as I said. I'm expecting this to pick up strongly. We've got strong cash flow generation. You can see these forecasts here. These are consensus forecasts. Even these alone are going to generate enough cash based on relative to the market cap. Basically, the whole market cap is going to be generated over the next 18 months. So if we see that pick up, the share price has to move up and can move up very strongly from here. If this is a sustained thing over a period of quarters, then we're going to see a share price well north of $20. And I would have thought somewhere between $30 and $40 would be a perfectly reasonable target if this dispute continues through for the next 6 months or so. So with this cash generation coming through, why is the market not really picking up on it? Well, the share price is. Market's forward-looking, is picking up. But as you can see from this, only one analyst so far has come through and upgraded their numbers. They've upgraded their numbers, they've upgraded their price target. And I think as each day goes by, through to the results in March, all these other analysts are going to have to upgrade their numbers, potentially upgrade their ratings and upgrade their share price targets. And that will provide a second wind for us as they get out there, talk to the market about that opportunity. Now, of course, this is somewhat of a binary decision, a binary outcome. If there's peace in the Middle East, if there's a ceasefire, if there is traffic flowing back through the Suez Canal, this will unwind. However, I think there's been enough cash generation now to sustain the current share price and provide a real floor. But more importantly, I want to structure my trade to have asymmetrical risk. So I know upfront that if this does all peter out and doesn't eventuate in the way that I want, the share price can fall back to $10, $8, $7. It doesn't matter. I'm going to structure this by buying July $15 call options. They cost about $2 at the moment, so my break even would be $17. As we've seen, this is a ridiculously volatile company, has huge amounts of fixed cost leverage in this business. As soon as those revenues start covering those fixed costs, as soon as the capitalized utilization rates start picking up, which they already are, then all that flows through to the bottom line, and that flows into the hands of investors through their 30 to 50% dividend payout policy. I would consider selling some March $15 calls as well, so turning it into a calendar 2-to-1 ratio to lower my entry cost. But if we see upgrades coming through, I can see how that potentially could race through even over the next month or so. So this is a bit of an outlier trade. The upside here, I think, is more than 100% from the current share price, which is why I'm just going to go and buy July $15 calls and put on my first geopolitical trade for an awfully long time, because they tend to happen super, super fast. They peter out. I think this time, though, there is that opportunity. Thanks again. Talk to you soon. Bye.